Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
This is Mike Leeson with Money Metals Exchange, and it is my privilege now to be joined by Frank Holmes, CEO and Chief Investment Officer at U.S. Global Investors. In 2006, Mr. Holmes was named Mining Fund Manager of the Year by the Mining Journal. He is the co-author of the book The Gold Watcher, Demystifying Gold Investing, and a frequent guest on CNBC, Bloomberg, and Fox Business, and you can find his company as well as his Frank Talk blog at usfunds.com. Frank, welcome back. It's good to have you on and get your insights during what has been an extraordinary month in the precious metals markets. How are you?
I'm great, and thanks, Mike, for giving me the opportunity to talk about global travels and markets and with your listeners. I'm very proud of, in addition to winning 24 Lipper Awards for Best of Breed for emerging markets funds and resource funds and gold funds in the past 15 years, we've also won 65 awards for education. So investors, please feel free to go to usfunds.com and sign up for Frank Talk or Invest Alert, and you can see the visuals and comments that we're going to make today. You can actually get the slide presentations on our website.
Yeah, it is great stuff there. I can certainly vouch for that. Well, I know time is limited today, so let's get right into it. Now, lots of gold and silver investors entering the month had expectations of higher prices given that Greece had defaulted on its IMF loan, but despite all the turmoil in Europe and heavy selling in Chinese equities, the metals could not catch a bid in the futures market. Why do you think safe haven buying has failed to materialize?
Well, I think it's been so much talked up that the U.S. is going to raise interest rates, and that's the great debate. When you look at the bond market, say the 10-year government bond, it says rates aren't going up in the fall. When you look at equities and the price of gold, it says no, rates are going to go up. And I think the bond market wins. I think the world is very different post-2008. The drivers for gold are both, I like to characterize as the love trade and the fear trade. And the fear trade dominates the psyche of North Americans. And the two factors that drive that fear trade are money supply growth and real interest rates. So whenever America has negative real interest rates, gold starts to decline in dollar terms. And whenever we have positive real rates of return, gold starts to decline. Positive real rates of return makes gold decline. Negative makes it rise. And if you go back to 2011 this time, we had negative real interest rates of 3% on a 10-year government bond. Now it's positive 2%. That's a big factor for the fear trade that gold has declined because gold with the fear trade is deemed as money.
I can definitely say that demand for physical coins and rounds and bars have been extraordinary this month. The U.S. Mint was overwhelmed early in July and completely stopped taking orders for Silver Eagles, as many people know, and they report a huge increase in sales figures for Gold Eagles. Here at Money Metals Exchange, we'll see nearly double our previous all-time monthly high in terms of ounces sold. That's across products.
That's very, Mike, that's very fascinating because that means the wisdom of crowds model where that person that votes, that person that saves and invests, is buying gold when it falls on sale, whereas the rest of the world is playing a game of trading in and out. And I think that was really dramatic to see that 5 tons of gold was dumped from the Shanghai market in a 2-minute window. And knowing that the Japanese was on a holiday and there was not a normal market of buyers, and the typical trading volume when they're there is 25 tons. So psychologically break the gold. And I share this with your listeners because this happened 18 months ago, that there was a fat finger was characterized, but then there's the Chicago Mercantile Exchange, I believe, did an investigation, and they slapped some people's hands for having high-frequency trading and flashing big sell orders to knock the price down. What happens, it appears to me, asymmetrical regulations. If we see gold knocked down in this sort of aggressive way, then it's looked upon and frowned upon But if it's moved higher, moved up, then by manipulation, alleged manipulation, then the regulators jump all over it. So it's very deflationary, that cycle of looking at capital markets.
Yeah, I mean, traders have been selling relentlessly, and there is a massive disconnect between the physical market and the futures market. I mean, what are your thoughts there? Do we have healthy markets and a functioning price discovery, or is something broken here?
Yeah, I think price discovery is a big issue, and it can be manipulated with the futures market. There's no doubt, but I will bet on smart money, and that is that wise person out there that's buying gold when it comes off at a discount. It's very refreshing. I'd also share with your listeners that's a very crowded trade, and that is short positions are the second all-time highest. So there's a lot of people that put on short positions, and I could see where it's being established, and I've written about this many times, what's called global PMI. And PMI is Purchasing Manufacturers Index, and it is forward-looking. GDP numbers are backwards-looking. So if you are trying to get an idea of what's going to happen in the next 6 months, it's important to look at PMI because you canvass the purchasing manufacturers, and they're going to use a lot of energy to manufacture metal products. So usually there's strong demand for metal and strong demand for energy when the 1 month is above the 3 months, and they're both above the magic level of 50. So what happened 2 weeks ago was the global PMI turned negative. Immediately, oil dropped $4. That week, the World Bank came out and said the global economy is going to slow down. And you saw that all the commodities started to take it on the chin, and countries' currencies, which were tagged to exporting oil, like the Canadian dollar, it started to decline. Colombia, the peso declined with that. So I think that's another factor we're going to take a look at short term. So that guys start establishing their gold position in the futures market, and then they knock it to become self-fulfilling.
I want to get more of your thoughts here on the inflation versus deflation debate, which is certainly getting more and more talk these days in the financial world. Right now, it looks like investors are preparing for deflation. The dollar is moving higher and commodities are selling off. It seems to us that higher spot prices in the metals are probably going to have to come with some weakness in the U.S. dollar. What do you see on the horizon that might derail this epic run in the dollar and then turn expectations back towards inflation again?
Durable goods. If you look at durable goods, which is looking back, they peaked last fall. And if you looked at the U.S. as a country alone, it's in Purchasing Manufacturers Index, they call it ISM, it peaked 6 months ago. So that strong dollar started impacting America's ability to manufacture products and export. Industrial production reflects that. So I think that's a real key factor that makes the Fed sensitive to raising rates. But where are we seeing inflation? We're seeing inflation, I see as a business person, in my regulatory costs. It just doesn't stop. And I talk to other businesses, et cetera, and they're all commenting on different forms and fashions of regulatory costs. Major financial organizations are being treated with this thing called FIFI. So there's big inflation in which you got to pay for that, and then the processing paper to turn that around. So that is, we see that inflation. Legal bills have gone up every year for the past 5 years. We see the audit bills have gone up dramatically. So it's interesting that the commodity deflation we're seeing in particular energy, which will trickle into the economy, and it takes about 12 months, according to analysis, that you start to see the big boom for that ability to help the economy.
Let's change gears a bit here and talk about the mining sector, an area you focus on a lot. We see various estimates with regards to average all-in production costs for gold and silver. We know every project has its own economics, and costs will vary wildly based on ore grade and a long list of other factors. But for many producers, current prices are below their cost of production, particularly when you include exploration costs associated with finding new deposits. So today's low prices are having an impact on production. How significant do you expect that to be moving forward?
Well, I think that this is going to be the bottom trough year for mining companies, where they're going to cut and slash everything they can to survive in this type of market. And so I've wrote about this, and when I was in earlier this year in South Africa, speaking at the Endowment Conference, I was commenting that we're going to see throughout this year a trough year, and guess what? Anglo-American, laying off, restructuring. 53,000 jobs going to go as they streamline. And what that will do longer term is create a shortage of supply. And the world's 7 billion people out there can continue to have babies. And now they're all wired and hooked up, and they all want the American dream. So I think that there'll be a snap up in commodities 2 years from now. And I think commodities like gold, copper, an interesting presentation, Mike, that was made. I thought it was a fascinating analysis by Macquarie. And they went back over 15 years of data points, and they said over $1 trillion was invested in mining from 2001. $300 billion went into iron ore, and $300 billion went into coal, most of it metallurgical coal, because you need metallurgical coal and iron ore to make steel. That $600 billion has gone into that. We have buckets of supply for iron ore prices, for iron and for met coal and coal. So those commodities are going to be amply supplied for the next decade. Now, there was a lot less money spent on copper, $150 billion, and gold, $150 billion, but there's been no major discoveries. So it's just been basically going into existing reserves and creeping out along the strike zones they have to have production. So I think that a lot of these mines will be depleted. You're going to see Pac-Man with mining companies buying other mining companies. So I think you're going to see that you want to have these good companies that have lots of reserves per share. They've passed through all the environmental feasibility studies. All they need is capital to go into production. There's very few, and they're going to get bought up. And so that supply still of these commodities for copper and gold and silver are not going to, they're actually going to shrink.
Keith Neumeyer, CEO of First Majestic Silver, has had plenty to say about the futures markets. In a letter to the CFTC, he expressed just outright disgust over what he sees as blatant manipulation of silver prices. He's also issued a call for other producers to withhold some of their production. Now, it doesn't appear his appeal is getting much traction, though. Can you envision producers working together in this way at any sort of a broad or meaningful level?
No, I don't think so. I think one of the smartest investors out there, Rob McEwen, who I have great admiration and respect for, he had the highest quality gold mine. Goldcorp had the highest grade per ton of rock. I mean, it was unbelievable. And when gold went through 300 and the way to 400, he said, we're making so much money, we're going to stop selling the gold because we think the gold is cheap. We think the gold is worth $800, not $350. And the other gold mining companies all thought he was crazy. He ended up being right, but from that example, here's a very successful person. He banked the gold, and the rest of the industry said no.
Well, as we begin to close here, I wanted to get your take on what you think the Fed's likely to do coming up later this year. Obviously, kicking the can down the road has been the plan of choice now for quite a while. Yesterday, they came out and looks like they may delay those rate hikes even further. What are you looking for there in terms of upcoming Fed policy?
I think the G20 was very different prior to 2008. Their real mandate was global trade. Dropping tariffs, streamlining process to move products, create jobs globally. Today, it's regulations and taxation. They want synchronized global taxation and regulations. And that means to do that, they have to keep interest rates low. Any spike in interest rates will derail any economy. And even Bernanke, when he left and had to go and redo his mortgage, covering the Wall Street Journal, it was complicated for him to be able to do that. The world's changed, and so I don't see them raising interest rates without a quick halt to any economic turn that the U.S. is enjoying right now on a relative basis. I see the IMF inspiring Japan to devalue their country's currency again and to stimulate economic growth. So I see Mexico's currency today is taking on the chin, and so with that, I think you're going to see continuous currency devaluations. And when you look at gold mining companies now, say out of Canada, lower oil prices, a big cost to them. They're paying their people in Canadian dollars. They're getting U.S. dollars. Canadian gold companies are doing exceptionally well. We love Cisco Royalty as one of our key royalty companies. We love Franco-Nevada. So we think these companies will do well. And we've always advocated that a 5% in bullion and gold coins and or beautiful estate gold jewelry, and another 5% in gold stocks, especially unhedged, high returns on capital gold stocks.
Lastly here, the last time we had you on, you were talking about the importance of rebalancing one's portfolio. Obviously, the portfolio for the precious metals investor is looked kind of rough here the last couple of years. What do you have to say to the gold and silver investor who recognizes that something's not quite right in the world, but yet they continue to see metals prices fall? What kind of advice would you have for them, and then also what are you looking for going forward in the metals?
So it's such a great question, and thank you for giving me the opportunity to share that with your listeners. I've always advocated that 10% and rebalance each year because there's going to be imbalances with government policies, monetary and fiscal levers. And gold performs exceptionally well when there's a mismatch and an imbalance. And then that's put in context globally. But I've also always said that you should be long stocks and you should be long short-term bonds. And you should rebalance those three categories each year. So your stock market's done well. It's had a great year last year. So you're taking some of those profits and you're buying gold. And you're buying some gold stocks. So, and if you look at those royalty companies I've been recommending, even though they're off here, they still outperform all the gold indexes. It's a very high margin business. And so they show up in our portfolio, but we have to have many stocks for a diversified mutual fund. But I think that the reason why we like them is their high margin business. So being long, rebalancing, and we have like a short-term tax-free fund that's been up for 20 years every year. It's a 5-star, and only 25 or 25,000 funds have been able to deliver 20 years of consistent performance. And that's what we say. You take some of that cash, which I do, and I rebalance into gold. So my gold's taking on the chin this year. I will take some of the profits from over there in the income and from my capital markets, and I'll average down on my gold.
Well, wonderful insights as usual, Frank. It was great talking to you again. We really appreciate your time and hope we can catch up with you down the road. Now, before we let you go, tell our listeners a little bit more about your firm and your services, and also some info about the fantastic and renowned Frank Talk blog.
Well, thank you so much. You're so kind. I work hard at it with my wonderful team, and what the thought process is that every week we publish with Investor Alert, and we do a SWOT analysis. It's like the pro sports. We look at the strengths and weaknesses that impacted the portfolios in gold. Last week, it's always only 3 key factors of strength, 3 of weaknesses, and then we say what economic data points coming out next week, what could be an opportunity for gold or the stock market or short-term fixed income, or it could be a threat to those in the short term, so that life is about managing expectations. And as Warren Buffett said, if you want to have a long-lasting marriage, have low expectations so everything is on the upside.
Well, great advice from him and from you there. So thanks a lot, Frank. Enjoy your weekend, and look forward to doing it again soon.
All right. Take care.
Well, that will do it for this week. Thanks again to Frank Holmes, CEO of U.S. Global Investors. The site is usfunds.com, and be sure to check out the previously mentioned Frank Talk blog, which you can find there at usfunds.com. And check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.